Cable is sitting at 1.3430, the daily chart is screaming strong sell, yet the 5-hour chart has lulled half the market into believing the worst is over. That is exactly the trap. Right now the pound is coiling inside a structure that looks neutral but is actually a reloading zone for the next leg lower. I'm going to show you the one danger zone and the one hidden opportunity sitting inside a 100 pip window. Stay until the end because I'm giving out 3 precise entry and exit levels, complete with stop losses and risk-reward ratios, so you can trade this plan immediately. Write down 1.3450. That is the line in the sand. If we break and hold above that level today, the entire bearish structure fractures. If we don't, the collapse we've been mapping for days enters its acceleration phase, instant market verdict. Our session bias is fade, and I mean aggressive fading of any rally. We are not buying this pair. The pound is a sell on strength until proven otherwise. The 5-hour chart is neutral because we are consolidating in a tight range, but neutrality inside a strong daily sell is simply a distribution pause. The one invalidation number is 1.3450. Write it down, put it on a sticky note. A 4-hour candle close above 1.3450 and we step aside because the daily trend would be challenged. Below that, every tick higher is a gift to add to shorts. So now that you have the pivot, let's build the case from the top down so you understand exactly why this trap is forming and where the real move will come from. Pull up your weekly chart. The pound has been in a structural decline since that failure at 1.3700, and the weekly close last week was a decisive rejection below the 60-week moving average. The 200-week moving average is still far below near 1.2800, so the gravitational pull is downwards. The MACD on the weekly is firmly bearish, with the signal line sloping lower and the histogram expanding below zero. There is no weekly bullish divergence, no hint of a reversal. That's the canvas. Now drop to the daily timeframe, where the strong sell label is painted in neon. The 20-day moving average is sloping down sharply and currently sits right at 1.3450. That's not a coincidence. The 60-day and 200-day moving averages are both above, with the 200-day around 1.3150, but the key here is the 20-day. For 3 consecutive sessions, any touch of that 20-day MA has been sold off violently. It is acting like a brick wall. Daily MACD is below its signal line, with both lines accelerating lower and no sign of a bullish cross. There is no hidden positive divergence on this time frame either. Price is simply making lower highs and lower lows. Yesterday's candle left a long upper wick, precisely from the 1.3450 zone, confirming that sellers are reloading there. The daily support zone below us starts at 1.3338 and extends to 1.3302, with 1.3294 being the next structural floor. That's where we aim. Now let's walk down to the 4-hour chart because this is where the trap becomes visible to the naked eye. Since the sharp drop early in the week, cable has been carving out a textbook bear flag. The pole is the impulsive sell-off. The flag is the gentle, low-volume drift higher. This flag is capped by the 50-period moving average on the 4-hour, which is also converging with 1.3450. The upper boundary of the flag sits around 1.34501.3460, the lower boundary around 1.3415. Price is currently in the middle, which means no man's land for new entries, but the structure tells us the next move is a breakdown. The 4-hour MACD shows a shallow bullish cross that has just rolled over, with the histogram bars shrinking against a flat signal line. This is momentum exhaustion. Buyers are exhausted. Look at this negative divergence between price and the MACD histogram. The flag makes a slightly higher high in price, but the histogram makes a lower high. Smart money uses this to unload longs and build shorts. Here's what most traders miss. They see the neutral 5-hour reading and assume it's safe to buy the short-term bounce. But the 5-hour neutrality is exactly what a flag requires to form. It's not a reversal signal. It's a continuation pattern. Once the flag breaks, the measured move takes us directly to the 1.3302 support, and with momentum, to 1.3294. The 60-minute chart adds a second layer. a rising wedge that has developed within the flag. The wedge support trendline sits at 1.3420, resistance at 1.3445. Rising wedges in a downtrend are bearish continuation. Patterns. When the wedge support snaps, we typically see a fast retest of the spike lows. The 60-minute MA20 has been guiding the wedge, but it is flattening, and the MA60 and MA200 on this time frame are both descending and capping any upside breakout. So the technical picture from weekly down to 60 minutes is synchronized. Sell rallies, target 1.3302 and 1.3294, invalidation 1.3450. Now let's move to the fundamental driver that just dropped and connects directly to this price action. Overnight, Burnham, a prominent figure with a plausible path to the Prime Ministership, explicitly ruled out changes to the UK's borrowing limits if he becomes PM. On the surface that sounds fiscally responsible, but for the currency market it removes the last hope of a fiscal bazooka that could jolt the UK economy out of its stagflation rut. The market had a small premium baked in for a future government that might loosen the purse strings to stimulate growth. Burnham killed that premium. The immediate reaction was a subtle but persistent bid under the dollar and a fresh wave of selling against the pound. This is not just a political headline. It directly tightens the fiscal straitjacket at a time when the Bank of England is already trapped. The bow is facing inflation above 4%, sticky services prices, yet growth is flatlining. They can't cut aggressively because inflation would reignite. They can't hike because the economy would buckle. That's the stagflation trap. When you add a fiscal rule that prevents meaningful government spending, growth expectations get downgraded, and sterling suffers. Meanwhile, on the other side of the Atlantic, the Fed is still hawkish, with market pricing swinging back towards a higher-for-longer narrative after strong labor data. The US 2-year yield is holding above 4%, and the UK's 2-year spread is widening in the dollar's favor. That yield differential is a tailwind for dollar longs and a headwind for cable. This is where the dollar killer's narrative becomes critical. Right now both euro to US dollar and pound sterling to US dollar are breaking down in sync. Euro to US dollar is testing key support levels, confirming that the dollar strength is broad-based and not just a pound story. When both dollar killers fall together, it signals a global shift into the greenback, often driven by risk-off flows. Look at the S&P 500, struggling to hold recent gains, with breadth deteriorating. The VIX is edging higher. Bitcoin is also seeing lower highs, tracking the S&P like the risk asset shadow it has become. Gold is under pressure as real yields rise, despite geopolitical noise. So the cross-asset web is aligned, stock shaky, gold heavy, euro and pound sliding, Bitcoin rolling over. This is a dollar-positive, risk-negative environment, and cable is at the front line. Over the next 1 to 2 weeks, my directional lean is for pound sterling to US dollar to test 1.3200 and potentially 1.3100. The one event that could blow up this thesis would be a UK CPI print dramatically above expectations next week that forces the bow to explicitly warn of further hikes, or a sudden Fed pivot. But right now, the path of least resistance is lower, and Burnham's comment just added a fresh fundamental log to the fire. Most people will skip this next section, but this is where money is made. Keep watching. I'm going to give you 3 precise strategies, each built for different risk appetites, with exact entry triggers, stop losses, and targets. Do not trade these blindly. Adapt them to your own risk management plan. Strategy 1, the sniper. This is the conservative approach. We wait for the trap to spring. The trigger condition is a 4-hour candle close below 1.3400. Why below 1.3400? Because that breaks the confluence of the bear flag lower boundary and the rising wedge support, confirming the pattern. A close below that level with volume expansion tells us the breakdown is genuine. Entry is on the candle close or a retest of the 1.3400 level as new resistance. Stop loss goes at 1.3465, above the flag high and above the 20-day moving average, giving the trade breathing room. The logic is simple. If buyers can push back above the flag and the key daily resistance, the entire bearish structure is invalid. Risk is 65 pips. Target 1 is 1.3338, which is the first support and former range floor. That's 62 pips of reward, roughly 1-to-1 risk-reward on the first partial. We take half the position off there and move the stop to entry. Target 2 is 1.3302, the major. Swing low. That gives an additional 36 pips on the second half. Total weighted reward is about 1.5 to 1. This setup is voided if we do not get a 4-hour close below 1.3400 before a break above 1.3450. Patience is the edge here. Strategy 2, the active trader. This is the standard pullback entry. We wait for a rally into the 20-day moving average zone. Entry condition. Price tags 1.34501.3460 on a 60-minute time frame and shows a rejection wick or a bearish engulfing candle. Confirmation could be a lower high on the 15-minute chart or a MACD bearish cross on the 60. The entry is within that zone, with a stop loss at 1.3505, just above the psychological 1.3500 handle and above the next daily resistance. Stop loss reasoning. A break above 1.3500 would signal a potential change of character, and we don't want to be short above that. Risk is 4555 pips depending on exact entry. First target is again 1.3338, a 120 pip move. Risk reward 2.2 to 1. Take partial profits there, then trail the stop to the entry level to create a risk-free trade. Second target is 1.3302, then 1.3294 for the final piece. Once target 1 is hit, set a trailing stop of 30 pips to protect the remaining position. The beauty of this setup is it uses the exact brick wall we identified, the 20-day MA, and lets price come to us. It respects the trend and the trap. Before I give you the aggressor play, let's see how aligned we are. Type your pound sterling to US dollar range for tomorrow in the comments right now. Give me a high and a low. I'm reading them, and it tells me whether the crowd is positioned with the trap or against it. Drop your numbers. Strategy 3, the aggressor. This is high risk and only for those who know how to lose small and manage risk aggressively. The idea is a momentum short from current levels, anticipating that the wedge is on the verge of breaking intraday. Entry, short at market, 1.3430, or on a break of the 60-minute wedge support at 1.3420 with a 15-minute close below. Stop loss is tight at 1.3460, which is the immediate swing high from the 4-hour chart. That's a 30-pip stop. Target 1 is 1.3370, a minor intraday support, 460 pips, roughly 2-to-1 risk-reward. Target 2 is 1.3338, for a total of 92 pips, and if momentum is ferocious, we trail the stop aggressively below each 15-minute candle low after 1.3370 breaks. This trade works if the bear flag breakdown accelerates without a final retest of the upper boundary. The risk is that the wedge does one final fake-out high to 1.3450 before reversing, which would stop you out. That is why position size must be tiny, and you must accept that you could get stopped out quickly. Only for those who are active and disciplined. Never risk more than 1 to 2% per trade. No positions through high-impact UK or US data. Stops are non-negotiable, so here is the one number that defines tomorrow and the entire coming session. 1.3450. As long as cable holds below 1.3450, the trap is set, the bear flag is valid, and the path to 1.3302 and 1.3294 is clear. A 4-hour close above 1.3450 would tell us the dollar killers are losing momentum and we need to reassess, but until that happens, shorting rallies is the only game in town. Tomorrow we have UK labour market data and US jobless claims, both of which could be the volatility catalyst that springs this pattern. If you want the full breakdown on Bitcoin and the S&P divergence and how that confirms the risk-off dollar bid, that video is live now, check the end screen. Smash like if this analysis gave you a clear actionable plan, subscribe and hit the bell for daily coverage of all 8 assets. I'll see you in the next one.